Hey, listeners, welcome back to the ValueHunt podcast. And today I'm really happy to be here with Sam McColgan. I guess we were both mentioned something like new microcap investors of the year or something. And then we struck a conversation from there. So, yeah, I think this will be an interesting chat. And I guess I'm curious to know where the conversation leads us. So, yeah, Sam, why don't you say a couple of words before I ask you some questions?
Yeah, absolutely. Well, I think you're right. We were named. I think it was the Young Microcap
Yeah,
Investors of the Year.
exactly.
I think you're probably. I don't know how old you are. I feel like I've got a few grey hairs coming through already, so I don't feel quite so young. But no, it was a pleasure to kind of get introduced to you that way, and I'm looking forward to our chat today. We've obviously messaged a little back and forth because it's our first time speaking, so I'm really looking forward to it.
Yeah, sure. And just a disclaimer, this was Andy from Twitter that mentioned us, so yeah, probably you shouldn't take that too seriously. But no, just kidding. Andy is a great guy. But yeah, before like going to more specific questions, I would like to know generally what's your background, like probably tell us a bit about your childhood and what shaped you into what you are today and yeah, what led you to investing basically.
Yeah, so I come from a village outside a town, outside a city in like South Wales. Wales is like a pretty small country or part of the UK. It's like 3 million people total, and yeah, it was a kind of fun place to grow up. I think that we I come from a big family, so I'm used to
Mhm.
kind of getting into arguments with people and trying to get my point forward. So I think that's one reason why I quite enjoy investing and also like presenting my investments and ideas. Um, and the discussions around other people's ideas too.
Yeah.
I think also for whatever reason, I developed a um, passion for like buying things on the cheap, like whenever I could.
Yeah.
Didn't come from yeah, obviously like a lot of money. So like the I wanted the money that I spent on different things to go far. So kind of by the time I actually had kids quite young, but by the time I have kids, I'm like always going to like charity shops looking for like super bargain discounts to kind of build up like a little toy collection and things like that. And
Mhm.
it's surprising like when I first started investing, like how it like translates to kind of like you're looking for something that's just like remarkably undervalued,
Yeah.
and yeah, but also like high quality. And it's funny how you kind of see these signs like or little indications earlier on, but you don't know. It's not until you kind of start investing that you kind of see how it actually fits the personality quite well.
Mm. Cool. Yeah, I think I guess most of the value investors have a similar mindset. So yeah, that's pretty cool. And my next question is actually on more of a current kind of development in your life. Obviously, you're taking an MBA at Stanford University or business school, if I'm not mistaken.
Yeah.
So I want to ask you, how is it being an MBA at one of the best schools in the world, I guess, and what does it take to be an MBA at Stanford, for example?
Yeah. um, Stanford is amazing. Like it's such a great place to be. I did my undergrad at University of Surrey in the UK. That was fun. I did
Hmm.
a master's also in Imperial College. Both of
Hmm.
those are like very very technical schools and great for like crunching numbers and learning like really deep theories. I think what's really special about kind of the Stanford, and particularly the Stanford MBA, is you get such a like broad look at so many different things. So it's very eye opening to kind of hear about people's journeys, consider different paths you could, I guess, be taking. Um, yeah, being inspired by just brilliant people who often have like overcome quite significant adversity to get there. The teaching's obviously like world class, and the classes are really interesting. But really, I think what's the most fun thing is just your classmates and getting to know them, and yeah, and being inspired by them.
Mm.
How to? I think your other question was like what does it take to get there, right?
Yeah,
And I
yeah,
think
yeah, exactly.
probably in some cases, certainly like a lot of dedication and hard work. I think in my case, somehow like a lot more luck, uh, which I think often like relates in investing. Like there's only you can do everything you got to do, but then there's also like just things that need to line up, and you just need to also be lucky. I mean, one of my actual like favorite investors, who's not a well-known investor, but his name's Chris, and he often refers to himself as like the luckiest man on earth. And I think that I'd like to try to also be lucky by putting things in my life to enable kind of serendipity to happen. Um, there have been kind of several instances where I've been kind of going down a path and then just something happens out of the blue, unexpected, which kind of diverts my path. And that's led me to investing. And I think that those kind of experiences also probably led me to Stanford. So I really do consider myself very lucky to be here and very blessed actually. And then hopefully a little bit of uh, hard work and intelligence, just like making up a small difference and a small component of that. Um,
Mm.
but for anyone who does want to go to like an MBA or something like that, I would say that probably the most important things are like making good relationships with people,
Mhm.
mentors, people who can vouch for you, and that goes a very very long way. So be someone who's teachable, be someone who's curious, and yeah, asking questions and getting on well with people.
Nice. That's pretty reassuring. All I do is ask questions, so that's pretty
You're
cool.
in a good place then. Yeah.
um, yeah, actually, my follow up question to the Stanford one is like, what what happens before after Stanford? So like after you've taken like one of the best degrees in the world, like in business and all that, like what does the future hold for you? What are your future plans? And probably after
Mm.
that question, we can dive a bit deeper into like actually investing and all that. But I was just curious, like about all this
Yeah.
Stanford part, because it's not every day that you get to talk with someone that yeah studies at these schools. So yeah.
Sure. A little bit of context. I actually applied for Stanford while I was still doing my master's degree in engineering. And at that point, I
Mm,
was thinking to use an MBA as sort of a. I knew that maybe the current trajectory that I was on in engineering wasn't quite right. So I wanted to use Stanford to kind of approach the industry, construction industry, maybe from a different angle. Um, since that point, I actually like pivoted twice, and I tried to start my own business. I ended up getting way too sick to start my business, and that's kind of when I first like picked up my investing book through recovery from that illness and fell in love with investing. So by the time that I became well enough again to go to Stanford, I had I had a very different career path in mind than when I first applied. So it really was a case of, is this still worth it or not? Like, why bother going to
mhm,
Stanford? And at that point, I suppose I thought to myself, well, I want to go from investing just for myself to investing in a company or at a firm, at a fund. I want to be able to learn from some of the best investors. I want
mhm.
to be challenged in new ways. And so really I decided to still go ahead with the MBA because I wanted to kind of give myself those opportunities. So I'm treating MBA as a chance to get a job at an investing firm that I really admire. And actually, like very recent development last week, I got an internship at Capital Group, and just really delighted. So I'll be doing an internship there, and assuming they like me and I still like them, afterwards I'll probably go work at Capital Group. Yeah, and that's the current plan. But I always find in life, you take things one step at a time, and things come out of left field. So just
Yeah.
have a plan, and then be ready for your plan to get thrown out sometimes. But yeah, hopefully it
Yeah,
works
yeah.
out.
I think that's a great advice, I guess, especially early in our lives as we are. I guess it's a lot of change. So yeah, now delving a bit deeper into like the actual investing side of things. Uh, how did you develop your current investment strategy? And as you said, like things are constantly evolving and changing. and I guess last year was pretty informative for you in terms of investing. So, yeah, how did that shape you into what you are doing today when investing in yeah, public stocks?
Yeah, definitely. Last year was very informative. I've essentially been investing for around 2 years now, and I more or less split those up into two periods. One is like trial and error and lots of errors, lots of learning, and essentially over the course of a bit over a year, let's call it around 15 months, like a lot of that was losing money and making wrong decisions and learning from them. And in the end, I ended up losing about 40% of investments, which was like it's so painful, like incredibly painful, but learned many things. And then kind of through the second period, so from about the summer of last year, suddenly managed to like turn around the performance, break even, and then a little bit more. Um, yeah, so I think there clearly was a pivot around last summer, and I think that the main part of the pivot went from I've always been invested in microcaps, but I didn't
Mhm.
really like truly know how to analyze risk in microcaps. So I learned a
Mhm.
lot about how to avoid losers and how to invest in companies that are already doing well, but the stock price hasn't quite caught up, but then also have more potential ahead of them. And we can delve more into it, but the the main process or the development has been like how to stop losing money on the losers. And at a very high level, my strategy is essentially like find these microcap stocks that you think can at least double within 12 months, but that you can practically see like no way that it will go wrong. And often, like as I've said many times, like things still go wrong. But if you kind of rule out everything you can possibly think of, um, you eliminate every type of risk, whether it's valuation risk, like management, earning risk, even just technical risk. When you take out all these levels of risk, then you're in a much better place. And I essentially went from, I think in the first period, like of the companies that I kind of picked or wrote about online, like over half ended up being losers. But then, in the last like eight or so, like haven't had any. Part of that, I think, is due to the market. I think the market generally has gone up, but I really have made a very conscious effort to kind of increase the batting average and not missing. So,
Nice. So there's two key kind of follow-ups to that. One is how do you avoid the losers? Because I guess that's the main insight from that experience. And then you talk a bit about like the technical risk and all that. So I saw you post some like cool charts and all that that I don't understand anything. So probably you can also explain to us whether you look at technicals and if yes, like how so. But probably start first by the how to avoid losers part.
sure. So I think that the technicals is part of it. So I'll just
Mhm.
talk about it as it
Okay,
comes
yeah.
up. But essentially, there's different ways a stock can go wrong, right?
Hmm.
Or an investment can go wrong. First is like and I've previously like spoken about like five M's is what I look for in an investment, and these often kind of these relate, so I'll bring them in. One is a monopoly, or at least like I want it to be best in class. Like something that could go wrong is they are just like one of many companies in an industry, and you think they're starting to kind of gain ground in the industry, but they're really just one of many players. So maybe a competitor comes out with a great product, which is just clearly better than your company's product, and you know, there's if you don't have some sort of moat around the earnings which they're generating or the growth which they're enjoying, then yeah,
Hmm.
then there's a big risk that competitors come in and take market share. So that's one risk. Another one is management. Like you don't want management to do something stupid, which happens. People like know it. Like microcaps are famous for it, right? I mean, we can't pay as much for managers, so you really have to find ones. I mean, you're looking for basically like value managers, right? That's a fun way to think of it. You're looking for good managers at a cheap cost because these microcaps can't afford expensive ones. You're looking for managers that aren't going to dilute shareholders. or at least if they absolutely have to, are doing it in like sensible ways, or perhaps they, it's okay if they're raising money not to keep on the lights, but to kind of turbocharge their growth or something like that. So I think there's different ways that a company can. Well, there's different aspects of kind of what makes a great manager, but I think how they treat shareholder money and their integrity is probably number one, and then their kind of skill set in terms of handling problems and issues that come up, and their vision and so forth. That's number two, and ability to close deals too. So there's those two aspects. Then I think I do look for like this kind of multi-bagging potential. And I think and I said earlier, at least a double within 12 months. And the reason I look for that is if you have a company, well, first of all, like if they make it, obviously, it's nice to have that upside there, right? If you're right on your thesis and you double your money, like brilliant, obviously. But it's also to do with like reducing the downside, because if there is a feasible way to double your money, let's say they only get halfway there, like they execute poorly and they get halfway there, well, you're up 50%. So part of it is like you're setting a sufficiently high bar that even if they miss the bar, like hopefully they get somewhere in the middle. The next one is what's the next one? Oh yeah, margin of safety. So I do think that I try to imagine, okay, what's this upside, and if they don't make it, that's fine. But what's if everything goes right, what happens? And then I think like, okay, what if everything goes wrong? So let's say their new product like is a complete failure, like it flops, the market hates it. Like what happens then? Like what is the valuation of the business as it stands? And if these unknown things, which are yet to happen, don't work out, or maybe they get blindsided by something or other, imagine the worst case scenario, and is the business like still sufficiently cheap? So I think if you're paying like 30, 40 PE for a company, and then something comes out of left field, which it often does, then you're at huge risk of like too high valuation. Whereas if something's trading at a 5 times PE or a 10 times PE, then if something goes wrong, like it's not going to fall that much. So those are the four, and then the last one is like momentum in the business, and I break that out into two things. One is like business momentum, one's price momentum. In terms of business momentum, I'm looking for an improving fundamental business. So I think often in microcaps, there's a temptation to look at, there's this great growth lever, great product, there's this huge upside if this works out. But then if it doesn't work out, what are you left with? What's the kind of core existing business? And if it's a business that's perhaps like slowly growing, doing fine, that's okay. Whereas if you've got like this business that's in decline, but they've got this new product. Well, if the new product doesn't work out, you're left with this business in decline. And markets really hate businesses in decline. So it's going to get really punished for obvious reasons. So I'm looking for kind of, and often it looks like this. Like I'm looking for a core existing business which is improving. And then I'm looking for something that's going to happen. Maybe a new contract, maybe a new collaborator, like some sort of change, like maybe a new management team, something happening in the business that I think could increase the value, like that could double the value in short order. That's essentially it. And the last one is related to the technicals, which you already talked about. There may be great value in a business, but if the stock chart is just like heading down and down and the market doesn't like the company, then at least in the short term, it's going to be very kind of painful to invest in the company because stocks usually keep doing what they've been doing. So typically, like what I really like is a company that's been in decline, but starting to show like signs that the market is waking up to a story, that the market is starting to appreciate a company. Because investing to some degree is like a story. The company is telling the story and the market is the person listening to the story. And so there's actually, people often like listen to one or the other. There's many investors who just purely focus on the fundamentals and are just listening to the story or observing the storyteller. And there's also like many traders who are just listening to the listener and what the market's responding to about the story. if you can kind of understand both elements, if you know how are the fundamentals changing and how will they continue to change, and how is the listener of the story, who is the market, responding to it? Do you see them like pick up their ears and start to say, actually, this is an interesting story to me? And by kind of understanding that it's not just one or the other, but it's actually a process, and understanding there's two parties that are actually important in that process, I think that's a key part of kind of reducing risk, and also kind of maximizing the returns by reducing the time in which it takes for the market to appreciate what you're appreciating.
Yeah, yeah, yeah. IRR is basically a function of, as you said, upside and time. So, and one thing that it's really interesting recently, I've been hearing a lot of people that kind of try to combine technicals with fundamentals, and obviously there's this common sense narrative that you can't time the market, but I guess that you're not really trying to time it, you just kind of listening to it, right? So yeah, that's quite an interesting approach, I guess. And one other question I have for you, and I guess it relates to this one, is why is your Substack called Breakout Investors Ahead of the Curve? So probably just
Mm-hmm.
explain that to us.
Sure. So first, I want to quickly speak about the first part, which is
Mhm.
I am not like nearly confident enough to think that I could ever like time the market. The market
Mhm.
is just made up of so many different components. Like some, I really like what like Howard Marks says about the market. Like there's so many unknowns. Like we don't know what's going to happen. But then even if we knew what's going to happen, we don't know how the market will respond to that. We don't know that Ukraine war will happen, but then didn't make that much big impact on the market, right? There's unknowns about what happens. There's unknowns about how the market responds to those. There's way too many unknowns, and that's why I just think it's folly for the average person like me, or even for 99.9% of investors, to think that they can time the market. That said, I think that there is a case for being more bullish and bearish on the market. Fine. You can play defensive, you can play offensive. Personally, I just, and this is probably just part of me being young and you being, I don't know what your strategy is or whether you think the same. I don't pretend to know that I can time the market, so I just think I'll just play offense all the time. But if I'm trying to basically reduce risk within the individual names within my portfolio, then even if there's a market crash, hopefully it's not so bad. That said, I do think it's possible to time individual stocks because there's a lot less uh, there's a lot less factors in how a stock moves than how the entire market moves. You don't have to
Mhm.
consider the entire economy. You just have to consider what's happening to this company at this time. So,
Yeah.
for example, if you know that this like contract that they've closed. An example is Intermap Technologies. They essentially closed a contract to do this enormous project in Indonesia, and the market just didn't believe it yet. But we had kind of good evidence and research to show that this contract will happen. Like in that situation, it's possible to time the market, not precisely, but
Mhm.
in general, you know that okay, over the next year, suddenly this project's going to ramp up from 0 to 100%. So whenever the market wakes up to that, I don't know how forward looking the market's going to be, but I've got some comprehension of what it will take. Like what is the thing that will happen that the market will at some point realize is going to happen, and so I don't know precisely when the market's going to wake up to it, but I know what it will wake up to, and then I can kind of position myself in the stocks where I think not only is there upside, but I understand when the upside will happen. I don't know when the market will appreciate that upside.
Yeah.
Um, then it also is a case of listening to the market and responding. Okay, the market is starting to pay attention to this upside. Then you can enjoy those kind of rides up. And I do kind of position myself more heavily in stocks which I think are enjoying momentum and also have a really great upside and potential. So I'm a little more nimble than some investors. Anyway, that actually, I suppose, leads on a little bit to the next question. But I would say breakout investors and the Substack's called ahead of the curve. Like, what's that all about? It's essentially a community of retail investors who subscribe. There's a free service and also like an elite service, and you can essentially get research about companies. Just like many investing Substacks out there. If you want to know about the companies we're following or hear about companies we have yet to follow, it's a great place to be. I actually started using the service and really liked it and started contributing, and that's essentially how I ended up being roped into the whole breakout investors thing. It's not only my platform; it's a platform that existed long before I started. A collection of several analysts who contribute. So I didn't have any part in kind of the name, but I can tell you the story. Well, the idea behind the name is essentially you're looking for a breakout. You're looking to be ahead of the curve, and obviously that's both of those imply, suddenly it's going up, right? That's what all investors want to invest in, things that go up, right? Yeah. So I think the idea is you want to understand what's going to happen before it happens, or you want to know about what's going to happen before it happens. And by having the best research that gets you ahead of the curve, you can position yourself accordingly to enjoy these stocks that go up. I mean, that's like high level, but yeah.
Okay, got it. I actually didn't knew it was like kind of many authors. I thought it was your Substack. So yeah, it's that's quite interesting. Usually when you see like a Substack, there's like only one contributor, and I feel like that's interesting. You can kind of get takes from different people and analysts, so that's quite interesting. So I think I also saw something in there. I don't know if it was you, but it was something like a short thesis on something. So I'm curious to know what what role does shorting play in your strategy, and if you ever do it, because I'm pretty scared of it, so I don't even consider doing it. So yeah, probably just tell us your take on it.
Yeah, absolutely. So I'll just say I'm probably not the best person to talk to about it. I have never shorted a stock. I have no immediate plans to short stocks.
Mm-hmm.
I think that it's a harder game to play.
Exactly.
And there are people who do it very well, but I'm trying to make investing like as low risk as possible and as easy as possible. And I'm having like very good success keeping it easy. So I have no need to kind of make it more difficult than it is. There are many people who do shorting as a strategy to kind of reduce volatility to the market, and I can appreciate that. But I think that the problem with shorting is that you're swimming upstream, right? Mm-hmm. I mean, in general, stocks go up. So by betting against that trend, you need to have some very good insight into why that trend is being broken. And it's just hard to do. Not only do you need to have the right thesis, but you also need to understand the timing. And you can't be wrong on the timing because it can go horribly wrong, even if you're right in your thesis. Like, let's say you short a stock that's just very expensive. Well, it might just keep being expensive, right? There needs to be something happen, like some shift in sentiment, and what's driving that shift in sentiment. In short, excuse the pun. I'm trying to invest on easy mode. I'm trying to invest where like everything's on my side, and by like making it overcomplicated. And I feel, by the way, exactly the same to do with using options and derivatives and so on. Like, I don't need anything complicated. I just need to find good companies that can double in 12 months. And that for me feels easy. And if I'm wrong, well, probably the company is not going to go to zero, right? So I think that, there's a lot more risk around making it complicated. And, you and I are also new to investing. And maybe after 10 years, I'll think that I know everything and start shorting. for some reason, but I don't know. I mean, I feel like I'm still learning. I feel like I'm still young, and I want to keep investing on easy mode as long as I possibly can.
Nice, nice, cool. And now that we have like a pretty good idea of how you think about investing and all that, I wanted to ask if there are any interesting ideas that are coming across your desk and that you want just share, or yeah, maybe some of the best ideas right now for you.
Yeah, so I keep a very concentrated portfolio, and many people who I respect have told me that I'm crazy to do so. Um, that said, for whatever reason, I believe in concentration, and so I'm only invested in a handful of stocks. And
Mhm.
the one that I'm most invested in is called Locify, which is the ticker LCFY. Disclaimer: I obviously own this stock. Um, what I like about it is there's something very tangible coming, and I don't know quite what it will look like, but I can tell that it's a lot better than the history of the company. So this is a company that has lost money for a long time. Um, they've been kind of developing expertise and product, but they've reached a stage in which they are starting to close like very big contracts with companies much bigger than itself. And for me, that's a validation of not only the product that it has, like it's a technical validation because all these bigger companies do like really extensive testing, and in some cases they even kind of they shorten those tests because they just thought, oh, this is working so well, we don't want to waste any more time, let's go ahead. Um, so there's a lot of technical validation that their product actually is working very well now. And if these products work out, I mean, this is a company that has historically lost money. It's a tiny market cap company, but even like one of these contracts working out would put the company at say trading like a 2 or 3 times PE, like incredibly cheap, and it would obviously show great growth and things like that. Now, I would say like we don't know all the bigger contracts, or both currently both of the bigger contracts will work out. We don't know quite what it will look like in terms of earnings. I mean, I can make estimates, but I just think it's just so much order of magnitudes better than how the company has been that I think investors will wake up to that. And that's like a very consistent theme of companies that I'm looking for. Another company I like is called Streamline Health, and the ticker is STRM, and obviously I own it. Disclaimer. But this is a company that has been like chasing EBITDA profitability for a long time. Like it's been really aiming to get there and has pushed back guidance to get there many times. And suddenly we're in a situation where the company is not, or hadn't been really officially guiding to EBITDA profitability in the near term, but there were signs that it actually is going to reach it very fast. And that's to do with kind of a loan agreement they had, and they're now closing like several contracts in like rapid succession. There were just like indications that this story that investors have been waiting to hear. I mean, EBITDA like cash flow break even is just like it's just music to investors' ears, right? And I can see that, boy, like the music's going to happen like in the next 3 to 6 months, and investors don't think the music's going to happen for a year. And so when they
Mhm.
kind of finally pick up on the fact that the music's like the party's getting ready, like everyone's
Mhm.
in the kind of disco or whatever already, right? They're ready to start like partying. Um, I just think that's the kind of story that I want to be involved in, especially when the valuation justifies it, and I like the management team, and I've kind of mitigated the other risks and so on. I'm looking for kind of these stories where something that investors have been waiting for a long time is going to happen very soon, but the market doesn't believe it. But I do.
Mhm.
So yeah, those are two examples.
Cool. Yeah, that's quite interesting. Like, how do you come across these kind of ideas? Do you manually screen for them? Do you rely on like other people? Like, what's your strategy there? Obviously, this is like more art and science, but yeah.
Yeah. Um, I do think like luck plays like a big role. Like I keep coming back to luck. I just think there's so much of luck in investing, but you want to put yourself in
Mhm.
positions where you can get lucky. So in order to find good companies, you need to, how do you position yourself to be lucky enough to find them? And I think one is like building relationships with people.
Yeah.
So, this is the first time we've had a chance to chat, but I'm hopeful, after this, we can trade forth ideas back and forth and things like that. You're looking for people that
Mhm.
you like really respect and who have great eyes for stocks to do the work, a lot of the work for you. And, you know, by and obviously like you need to have something to share and exchange, otherwise they're not going to bother wanting to talk to you. But
Yeah.
there's so many brilliant investors out there, and I don't need to be the genius. I just need to kind of also acknowledge the stories happening before the general market does. And so I think
Mhm.
there's a case for getting to know people, building relationships, and expanding the network and having conversations with people. Twitter is a great place. We obviously met over Twitter, or X now. Get to know people and share ideas. I think
Mhm.
I'd say a lot of my ideas come from network. I would say that an interesting one that many people may be surprised at is I actually like talking to sell side analysts, which many people are like, well, why do you listen to them? They're just trying to sell you something, and
Yeah.
you have to know that they are trying to sell you something, but nonetheless, it reduces the pile of stocks. And the way that it reduces is companies, especially microcaps, don't usually want to pay for sell side research. They don't have a lot of money. They go to these kind of sell side research when they think, actually, we deserve a much higher stock price. And we think that something is happening in our story that investors should know now. Um,
Mhm.
so, by kind of understanding companies that are just starting to come to these sell side analysts, it often is an indication that their story is changing, and you should at least give it a glance. So that's another place I like to look at. I don't use screeners because I think I want to find the stocks that are screenable in 12 months, but aren't screenable yet. It's to do with that. I want to understand the story before it's played out. So I don't use screeners. The last one I'd say is just looking around you, like watch presentations online. Like I often watch like Planet Microcap, found investments like through there. If you're in the position to attend conferences like microcap conferences, that's another great place to go speed dating with CEOs and things like that. Yeah, it's put yourself in positions where you hear about new stories and keep talking to people.
Nice. Cool. And how do you actually talk with sell side analysts? Because do you call them or like they call you? Like how does it happen?
Uh, how does it happen? Often when I first like, if let's say I find a company that I'm interested in, I might contact the IR team at first, have a chat with the IR team, and obviously they're obviously representing more than just that company, so they'll help me get in touch with the management team. But then they'll also often say, "Oh well, have you like thought about this name?" Or uh,
Mhm.
I think it is a little bit unique just because I do write online, just like you do. And microcap companies want people to know about them. So there's an incentive to have people who write about stocks. There's an incentive to connect with those people to get their story out there. We're
Yeah.
essentially a resource. So like it's a two-way street, right? We want to learn about the company and understand what's going on, and they want more people to know about the story. So I think you and I are in a, you know, uh, an easier position than just an average investor in terms of connecting with management teams, and I acknowledge that advantage. But yeah, I think that if you make good relationships with IR companies, like be professional, like be helpful, and maybe I wouldn't know, but maybe there's a chance to build relationships even if you're just kind of an ordinary, like an everyday investor. I don't know. Maybe worth trying. I don't know how successful it would be.
Mm. Yeah. Yeah. One thing I'm trying to do more is like actually get in touch with CEOs and all that because I feel like you can learn a lot, especially in microcap companies, because usually the narrative is that you shouldn't talk to with the management because they yeah, you might start liking them and then you get biased. But
Yeah.
I feel like in microcaps there's a lot of these common sense kind of Warren Buffett's yeah, advice that doesn't apply
Yeah.
too much, and I think that's really what also creates these opportunities, right? So that's quite interesting.
100,
But
100%. Just very briefly on
yeah,
that.
yeah,
You
sure.
absolutely need to, if you can, talk to management. If you can't, listen to presentations from the management team that they might have done online or at a different conference. Like you 100% need to listen to the management. And you can't always, you need to be skeptical of what the management team is telling you. Like they're going to paint you a rosy picture because they're trying to sell their company to you, right?
Yeah, exactly.
But at the same time, they have so much good information and you can't waste it. So you need to be actively trying to listen to management and learn all you can from management while also having very skeptical hat on.
Hmm. Yeah, and the incremental information you get from it, it's much higher value than what you would get in a big cap or something. Because yeah, it's just more people
Because their
looking at
stories
it,
are
and
known. Yeah,
yeah,
absolutely.
yeah.
So for example, I went to a conference, speed dated with many CEOs, and from one of those kind of CEOs, he kind of pointed me out the fact that there's these very big things coming up that investors don't know about. Well,
Hmm.
sorry, I should rephrase that. It's public information because they disclosed like the companies that they were going to be working with. It's basically
Hmm.
the company's hardcore ticker is HTCR, and I do not own it, but I did own it. And they basically pointed out the fact that hey, we're going to get like a lot of money, like in Q3, like a lot of money. Like we're going to go from net debt to net way positive in cash because of this kind of big deal that's happening. And it's public information, but it's a microcap company. No one's looking at the company. So the story is just not out there yet. So just by having that conversation, I'm able to kind of realize, wow, this company is going to go from like a very risky company with a bad balance sheet to a much less risky company with a great balance sheet. The story is like so fundamentally changed. Uh, so just like insights like that can help investors to kind of get ahead of the curve to
Hmm.
notice things that aren't noticeable because people just aren't looking at these tiny companies.
Yeah, sure. And like my last question to that point is that if you look enough into microcaps, there are a lot of microcaps out there and a lot of ideas that seem really interesting. And then it comes down to like opportunity cost and all that. And especially if you run a concentrated portfolio like you do, there might be the temptation to constantly be switching into newer ideas that seem like better than what you currently have. So, how do you strike a balance between like optimizing your portfolio for the highest IRR and
Mm.
like best opportunity set, with actually giving your ideas enough time to make those transformations that will eventually lead to, yeah, the multi-baggers and all that. So I guess you also have to have a degree of patience, but yeah, I'm just curious to know how you balance that, because right now I'm
Yeah,
finding more ideas than cash, so it's quite
yeah,
like hard to, yeah, manage that.
yeah. So I do think there is a case to say you should allow yourself, if you really find a better story, then invest in it. Like I've been in a position where something's playing out and maybe it's gone up a little, but not nearly as much as I think that it deserves yet. But then I find something better. And I think that when you find something that's just really like truly better, let's say it has lower risk and higher upside, then then you need to be nimble and just need to say, okay, the
Mhm.
last story was good, but this new story is better. Um, that said, I would say I since being at Stanford, I have been I have not I've not had nearly the time that I had before Stanford, and so
Yeah.
I've not been looking at new ideas. So I get people like sending me ideas all the time since being here,
Hmm.
um, and say, "Yeah, you got to look at this new idea." And some of them have done like terrifically well, and some haven't
Hmm.
done as well. Um, so I've certainly missed out on opportunities, and one example of that is TSSI, which is a stock that's kind of heavily involved in the AI story. And yes, obviously, I wish that I'd invested in that stock because it went up like 10 times or whatever it was, and you need to be okay with missing opportunities like that. But by just sticking with what I've had and not looking at new stories, I've still been able to essentially triple my money since the summer. And
Mhm.
and and that's basically just like trying to ignore everything going on around me, saying I do not have time
Mhm.
to look at new ideas. So I've been kind of forced to stick with what I have, and it's done like very, very well. So I
Yeah.
think that in summary, like, yes, if you really find a better idea, go ahead. But there is something to be said for not just like jumping left, right, and center so like frequently, unless something is really definitely better. Like, be heavily skeptical of new ideas. And what you have,
Mhm.
you've already vetted in your portfolio. It's already made the cut. So if something is going to come in, you need to like do really deep due diligence to make sure it truly makes the cut better than what you have. And you know, if you miss a few opportunities along the way, so be it. But you know, for someone who runs such like a high concentrated portfolio, I can't afford it, but I do not want any of my stocks to be losers. Like
Mhm.
I don't want to lose on any name that I have. I want every name
Mhm.
to make it, and that won't always happen. But it's just much better off to be highly skeptical of new ideas,
Mhm.
and trust in the ones that you have as long as the stories are still playing out as you'd expect, and be patient.
Yeah. Yeah, I think that's great advice. And I don't know, like if you have any income or anything like that, but basically, if you're a student and you are fully invested, you are basically running a closed end fund. So
Yeah,
like like any idea that comes that is new, you have to let go of something. So yeah, I think that's an interesting challenge that I've been facing recently. So yeah, thank you for your advice. And I guess we've had a very interesting conversation. Probably we could do this another time and just like pitch ideas or something like that. I think that would be pretty cool. And my last question, just to really close the interview, is like how many companies you have in your portfolio? Because you're saying like I'm pretty concentrated, but sometimes
yeah,
people say like I'm concentrated, but like they have 20 names or something, and to me that doesn't feel too concentrated. But
yeah.
yeah,
I have
just
four. I have
okay,
four,
okay.
which is
So
obviously like what many people would call very concentrated.
yeah. That's like what Charlie Munger preaches, right? So 3 to 4 or 5 something names.
Yeah, and
So
I do think there's a lot of value in it. There's no way that I would have had the performance that I've had in the past 6 months that I would have if I had a wider portfolio.
mhm.
The thing is, you just need to, if you run a very concentrated portfolio, you need to set a very, very high bar for risk. And, you know, upside, yeah, sure, but like the risk, you just need to make sure that you don't have losers because it can weigh down so heavily, and you also need to be ready to stomach like big volatility. Like
Yeah, yeah.
in January, I'm up like 20%, but in the last like 2 days, like suddenly my whole portfolio is down like 10, 15% or something like that. Like it's volatile. Like you just need to like be willing to stomach big volatility and not stress about it, and remember the stories rather than the fluctuations. Like, why are you invested in this company? Okay, I still think that I'm more sure now than I was 6 months ago that this company is on track to deliver this story. So that's okay if it drops like 20% in a day. Just get over it and just kind of keep looking to the story. And I would say technicals, like, this is probably a side tangent, but if something like when I said 20% drop, there's probably a reason for that, and do need to like very seriously consider what the reason for that is and how sentiment may be shifting or how fundamentals may be shifting and kind of factor that in. But
Mhm.
yeah, anyway, that's a side tangent.
Yeah, I think that's about it. And obviously probably our first year salary will be bigger than the whole portfolio. So it's I don't know about you, but I'm talking for myself, and like it's easier to weather volatility when you have that in mind, and you're young, and we are young, and so on.
Yeah,
So
absolutely. We're young and we have our kind of futures ahead of us, and essentially the the money that we're investing now is an opportunity for us to learn how to invest bigger amounts of money later on in life, right? So
yeah,
and
exactly.
and,
Yeah.
and we're young and have opportunities to earn money, even if everything goes horribly wrong. But
Hmm.
yeah,
Yeah, for sure, for sure. I think that's the perfect note to end with. And yeah, just wanted to thank you so much for coming and agreeing to have a chat with me. And probably just tell us like where can people find you. Obviously, I'll link down below your Twitter and all that. But yeah, just where do you want to redirect people? I guess.
yeah, thanks. First off, David, it's been an absolute pleasure. Really fun to chat with you, and I hope we can chat again soon. And I feel like it's been mostly one way, me answering questions, but hopefully next time I can ask you some too. Uh, in
Yeah,
terms
sure.
of how people can find me, you can find me just with my name, Sam McColgan, which I'll link below, and that's on either Substack or X. And I do also obviously write in Breakout Investors Ahead of the Curve Substack. So if you follow me or the Substack, you'll find me. I'd recommend following both on Substack and X, because I have many great mentors around me and analysts who I respect very much and are worth following as well. And yeah, I'd say there's even so if you're interested in microcaps, it's no harm to you to join Breakout Investors. I'm way too cheap, so I joined Breakout Investors, and I didn't want to pay for the elite subscription because I'm too cheap and don't like to pay for things. But I still got so much out of the free service that I wanted to start contributing, and eventually
Hmm.
kind of joined the team. But yeah, it's a really fun place to chat about ideas with people, and yeah, would love to see anyone there who listens to this and uh, likes microcaps and wants to chat about them with us.